Hi everyone, good morning. So previously we have talked about loans. We have talked about Just give me a moment. We have talked about loans. We have talked about debt. We have talked about bonds. We have talked about amortization schedules, different type of amortization schedules. So that was all the easier part. Now we are going to start with the difficult part, and also this is actually the good stuff. Uh, the good stuff in the debt structures. So a very important concept, that's tranching. So today's lecture is about tranching and one of the most important and widely used concept in modern finance, and especially in debt markets, securitization and structured finance. Also in private credits along with credit finance. So even if you never work in structured products, understanding tranching is essential because uh, it explains how risk is sliced, risk is priced, and risk is actually sold in the financial markets. If you want to remember, if you want, I just want you to remember one thing, just one simple line for from today's episode. That tranching means slicing. Tranching actually means slicing the same pool of money into parts that get paid in specific order. And everything else we discussed today is simply a deeper explanation for that one sentence. That tranching means slicing of same pool of money into parts that get paid in specific order. So before we define tranching formally, let's understand why it exists at all. uh, so in real world, different investors have different risk appetites, and some want safety and predictability, and others are willing to take higher risk for higher returns. If everyone invested in a loan pool equally, then everyone would share same risk equally, and everyone would earn roughly the same return. And many investors would simply stay away because the risk return profile would not suit them. And tranching actually solves this problem. It allows the same pool of cash flow to be repackaged into low risk investments, medium risk investment, and high risk investments, and all backed by the same underlying assets. So that's why we need tranching. And let's discuss the core idea of tranching in plain language. So let's strip this down to its essence first. So instead of everyone sharing risk equally, tranching decides who get paid first, who takes losses first, and who earns lower versus who earns higher returns. And this is the heart of tranching. Think of it as a priority system. Higher priority means it's safer and there are lower returns. Lower priority means it's riskier and there are higher returns. Just like equities and debt. Uh, Debt actually has lower return, but it has actually the first priority. Equity has higher returns, but equity has lower priority. It's riskier, debt is safer because whatever be the market circumstances, whosoever holds the debt, they actually have to pay at least the interest, and at the end of the tenure, they actually have to pay the whole principal. So this trade-off between priorities, risk and return, is the foundation of structured finances. The concept of priority, when we talk about the concept of priority, in any tranching structure, there is a clear ranking, typically senior tranching, mezzanine tranching, and equity or junior tranching. So senior tranching actually has the highest priority. Mezzanine tranching actually is the middle priority, and the equity and the junior tranching is the lowest priority. Uh, Priorities affect everything. So, who receives cash first, who absorbs losses, how rating agencies assess risk, how investors price the security. You can think of priority like standing in a queue. People at the front are served first, and people at the back only get served if there is something left. Now, understand how tranching works conceptually. So, tranching actually operates in practice. Let's understand that. So there are three core mechanics. Cash flow comes in from loans or assets. This means that the structure start with assets such as loan, mortgages, bonds, project revenues, lease payments maybe. And these assets generate cash inflow. And the cash inflow is uh, interest, principal, and fees. All cash flows go into one common pool. The cash comes in from pools, cash comes in from loans and assets, the first part of tranching. The second part is payment through waterfall. So once cash comes in, it is distributed using a waterfall structure. A waterfall simply means payment flow top down. So waterfall means payment flows top down, and we will be discussing about that waterfall structure. In our future, one of our future episodes, we will be discussing about that waterfall structure. So payment flows in a waterfall. Once cash comes in, it is distributed in using a waterfall structure. Waterfall simply means payment flow top to down. Senior tranche get first paid first, and junior tranches are paid last. So senior, mezzanine, and equity. So when the cash comes in, and that's a different thing. But when the payment follows, when you are actually paying somebody back, so payments will follow this specific structure. First, the senior tranche will be paid, then the mezzanine tranche will be paid, and then the equities tranche will be paid. This is low risk, this is medium risk, and this is high risk. Priority, high priority, mid priority, and this has low priority. So payment flows top to down. Senior tranches get paid first. Junior tranches are paid last. No discretion, no negotiation, just rules. And losses flow in reverse order. And this is extremely important. Losses flow in reverse order means so equity tranche absorbs losses first. So if there is a loss, so they actually have low priority means high risk means this will be first, this is second, and this is third when we talk about losses. So if we have any loss, so equity will absorb it first, mezzanine will absorb it second, and after absorbing after so it will not uh, go till it will it's uh, in most of the cases it do not reaches senior debt, but it is absorbed by equity and mezzanine almost. So But yes, the claim in losses is the third. I mean, the senior is the last to have a claim to absorb the losses. And this asymmetry is what makes senior tranches appear safe. And let's talk about a very simple example. So, uh, imagine a pool of loan. There is a pool of loan. So, every month they are generating 100 rupees every month. So, they divide this into three tranches. Tranche A gets paid first, tranche B gets paid next, and tranche C gets whatever is left. That's the risky part. And normal situation is if 100 rupees comes in, tranche A get paid, tranche B get paid, and tranche C gets the remainder of it. But if only 70 rupees comes in, so tranche C loses first. Tranche A is protected. Tranche B may lose something next, but tranche C loses first. So let's imagine. Let's say let's take hypothetical number. So if out of 100 rupees, tranche A gets 30 rupees, A get 20 rupees, tranche B get 30 rupees, and tranche C get 40 rupees. And this is summing up to, so let's say it's because this has low risk, that's why it is getting only 20, this is getting 35, this is getting 45. This all adds up to be 100. So if only 70 rupees comes in, the tranche A is protected, it will still get 20. Tranche B is protected because the impact will not reach to tranche B. So 35 they are going to receive. And the tranche C is going to lose 30. Uh, 30 will be lost, tranche C will lose 30. This means tranche C will only receive 15 in this circumstance. All right, I hope you have understood the core concept of tranching, and that's all. See, understanding the basics important. The basic concept is important, and you will when you will apply it anywhere, a lot of fancy terms will come into play, a lot of technical terms. But if you do not understand the basics, you will not be able to apply them. So understand the basics of tranching. This is what the tranching looks like, and you can apply it anywhere. So if you have if you uh, uh, just a saying, don't rely on the calculator that much that you forget how to subtract, add, subtract, multiply, divide manually. Okay, now let's move to why tranching is used. So now let's discuss why why this structure is so why this is a structure is so powerful. So this structure is used to manage risk distribution. So tranching allows risk to be concentrated where investors are willing to take it, removed from investors who want safety. So tranching actually remove risk. Tranching actually allows risk to be removed from investors who want safety, and tranching actually allows risk to be concentrated where investors are willing to take it. Instead of spreading the risk evenly, so instead of spreading the risk evenly, it is allocated deliberately. So here there are people who are willing to take risk. These are the people who are actually willing to take risk. And here there are people who are not willing to take risk. So those who are actually willing to take risk, they will invest their money in tranche C. Those who are not willing to take risk, they will invest their money in tranche A. So tranche A will have lesser return, less return. Tranche C will have high return, high return. This has less risk. Also, this tranche C will have high return and risk both. The another point why tranching is used, it's so different tranches attract different investors. When we talk about uh, senior tranches are preferred by pension funds. Just give me a moment. Just give me a moment. So when we talk about this part, so senior tranches, there is mezzanine tranches, and there are equity tranches. So senior tranches are actually preferred by pension funds, insurance companies, and banks. When you talk about mezzanine tranches, these tranches are preferred by credit cards or credit funds and hedge funds, not credit cards, but credit funds. And when we talk about equity tranches, so equity tranches are actually preferred by private equity sponsors and originators. So this actually expands the investor base. So tranching is used to attract different type of investors. Tranching is used to manage risk and redistribute risk. Redistribute risk is based on who is willing to take risk and who is not. Who is willing to take risk and who is not willing to take risk. Third point here is to reduce overall borrowing cost. So overall borrowing cost, because senior tranches are safe, they demand lower interest rate, and this reduces the average cost of capital. Even though equity is expensive, the weighted cost is always lower. So when we borrow debt, this reduces overall borrowing cost. If you are issuing senior debt, uh, if if somebody is raising debt through a contract which the market perceives as senior tranches, so the terms and conditions are, uh, I mean, it satisfies uh, to make it as a senior tranche, as a senior debt. So in that case, the interest cost is going to be very low, and this will actually reduce the overall cost of capital. Reduce the overall cost of capital. Overall cost of capital, even though the equity is expensive, but because how much the how the the capital structure of a company is distributed, and tax shield which comes with debt, actually it actually lowers your overall cost of capital. Just okay, let's talk about the point number four. So when we talk about tranching, the why tranching is used. Tranching actually the custom risk return profile. So tranching, we use tranching to create securities with different risk return profiles. This means that tranching creates conservative investments, balanced investments, and aggressive investments, uh, all from the same asset pool. So there are going to be conservative investments, conservative, aggressive, and balanced. And if we talk about conservative, so those who actually have conservative mindset uh, regarding investments, they majorly go towards debt. Conservative, this is conservative. When we talk about aggressive, so if you have a if an investor actually is aggressive mindset, so they will go towards equity. uh, this actually is aggressive. uh, those who actually want a balanced investment, here in mezzanine, yes, it's representing balanced uh, investment. So if you ask your old folks, um, they will always recommend you to go towards debt securities, fixed deposits, RD, recurring deposits, FD, RD, uh, gold, land, real estate, not flats, but land. They will majorly suggest you to take position in all these. If you ask somebody who's from a hedge fund, they will majorly recommend you to go to equities. Uh, and a mix of both of these will give you a balanced investment. I hope you are able to understand what tranching is now. Uh, okay, so where is tranching used commonly? Now let's talk about that. So tranching is basically tranching is commonly used in uh, debt financing. Tranching is very commonly used in securitizations, ABS, asset-backed securities, mortgage-backed securities, ABS and MBS. Uh, Tranching is used in structured products. Tranching is used in project finance. Tranching is used in private equity and private credit funds also. So tranching basically means this is representing a tranche. This is senior, mezzanine. Mezzanine basically means middle, and this is equity. So anywhere where there is a priority on claims based on risk, based on return, uh, priority of claim, there is a priority on claims. Here, the return is less. The return is lesser. Here, the return is more, and here is in between less and more. High and low. It's in between low and high. So anywhere you see there is a different priorities in claim. Cash flows can be ranked, tranching can exist. So basically, cash flows can be ranked. So that's tranching. Mhm. And if you want a formal definition, what you can think about tranching as is that tranching is structuring the financial cash flows into prioritized layers, allowing predictable payments to senior investors while allocating higher risk and return to junior investors. Okay. So since we have discussed about tranching, now uh, let's do a detailed question, uh, detailed example where there's a 1,000 crore principal that generate annual cash flow. So these loans generate annual cash flows. We have created three tranches here: tranche A, tranche B, and tranche C. Tranche A is senior, tranche B is mezzanine, and tranche C is equities. So understand this thing. The size of the senior tranche is 700 crores. The size of mezzanine tranche is 200 crores, and the size of equity tranche is 100 crores. Priority, we have classified the priority first, second, and third. The senior tranche has the first priority, mezzanine has the second priority, and the equity has the third priority. And coupon, the returns on senior tranche is 6%, the lowest, a little more on the mezzanine, and the little higher. Whatsoever is left is it actually goes to the equity. Annual interest due. Now let's talk about, okay, before that, since we have talked about coupon, so this means when we talk about this, the 6% of 700 is 42 crores. 700 into 0.06 is 42 crores. 200 into 0.09 is 18 crores again. And the rest of the residual, we are not able to calculate the residual because no percentage. So there is no fixed coupon. So whatsoever uh, above, whatsoever is left, 4, 6, 7, 60 crores. So whatsoever after 60 crores, that's going to equity. I hope you have understood this thing as of now. So let's discuss about a case where there is full cash flow, no stress. So there is a cash flow of 120 crores. So waterfalls will be distributed. The senior tranche will get 42 crores, the mezzanine will get 18 crores, and the remaining 60 will be paid to the equity. And yes, all tranches get paid. Equity earns highest return in that tranche. Then there is moderate stress. When there is moderate stress, so total cash flows are 70, and we have established uh, previously here that above 60, anything that we generate above 60 will go to the equities. So when the total cash flow is 70 crores, so senior will get 42, mezzanine will get 18. That's obvious. But the remaining 10 crore will go to equity, and equity takes the hit. Mezzanine and senior debt are protected. This is how actually a cash water flow will work. And see, this if you talk about the concept is that easy, but applying that concept in multiple equations, multiple situations, multiple securities, and uh, collating everything down to one stream, uh, uh, streamlining everything. That's the difficult part, and for that you need to have the crystal clear concepts. So that's why I'm making it old school style, uh, rather than making it an AI generated video. I'm trying to make it as simple as possible for everyone who is watching this video. And let's talk about the case number three. So case number three is where there is a severe stress, but not very severe. Not it's a little stress is there. Yes, they have generated the cash flow is 50 crores. So senior debt will not take any hit. The first hit will be taken by equity, but mezzanine will pay something. At least they will pay something, but equity will get zero. This is where the equity will take all the hit. Equity will get wiped out, but mezzanine gets partially paid, partially unpaid. But yes, partially unpaid also means says the same thing. Partially paid. And in the fourth case where there is extreme stress, so this is actually a crisis scenario. So waterfall distribution, the senior gets 30 crores because they only have 30 crores. They have generated total cash inflows of 30 crores only. Mezzanine will get zero, equity will get zero. Even senior suffers losses in these kind of situations. And looking at case number one, two, three, four, the outcome here is that the even senior suffers losses and entire structure under stress. Entire structure is under stress in these kind of situations in case number four. And this shows that senior tranches are safer, but they are also not risk free. So, loss allocation in a reverse waterfall structure. This is now simply, this actually, this now explicitly states the rule that cash flows go top down and losses go bottom up. So this means that cash flows will go. This is if the cash flow is this is cash flow. So cash flow will go from senior to junior and mezzanine. Mezzanine basically means middle. And when we talk about losses, the losses will go from down to up, and cash flow will go up to down. So equity uh, is also called the shock absorber. Here the junior means equity. Senior tranche gets higher rating. So these will be higher rating because rating is based on risk. So here the risk is low risk, high rating, highly rated, low risk, high risk, low rating. This means highly rated means and low risk means less return, and here it means high return and high risk. Less risk, we have established that already. Okay, we have already done high risk. I hope you have understood what I'm trying to deliver here. Uh, so quickly, just let's just discuss about the key insights of why tranching exists. So tranching exists. Uh, the, let's summarize this deep insight. So first, there is senior tranche, which appears low risk because many layers absorb losses first. So many layers actually absorb losses before this. Um, there are many layers here. Equity, mezzanine, and equity is also divided into different layers. Then mezzanine is actually divided into different layers. So before the loss actually reaches a senior or before the loss actually reaches the senior tranche, it is actually absorbed by many layers. Uh, Cash flows are predictable in senior tranches and default probability is lower. When we talk about equity tranches, so equity tranches absorb volatility. This means that equity takes losses first, gets gradual upside, and acts like a buffer. Multiple investors are attracted here in the third point. One asset pool can satisfy conservative, yield seeking, and risk tolerant investors also. So that's the key insight here. And rating agencies prefer senior tranches because structural protection reduces risk and not because assets themselves are safer. And this distinction is actually very critical. So rating agencies actually prefer senior tranches. Understand this thing. Because Why they prefer senior tranches? Rating agencies prefer this thing, prefer senior tranches because protection here, structural protection to absorb risk, and there is a layer of securities before. I mean, these securities will absorb risk first, so that's why it's preferred by rating agencies, and not because assets themselves are safer, but this structure is safer. This distinction is actually very critical. If the underlying asset, um, uh, we are not talking about the asset as of now, ABS and MBS, but the structure you need to understand. Why senior, why senior tranches are preferred by rating agencies. I hope this much is clear. And the final notes. So, whatsoever we have understood throughout this lecture. So, one line summary, which will be also perfect for your interview. So, uh, the cleanest possible summary is that the cleanest possible way simply is a tranche waterfall allocates cash flows top to down, losses bottom to up, creating securities with different risk return profiles from same asset. And if you understand tranching, you will understand how modern credit market functions, how structured product exists, how risk is engineered and redistributed, and everything else. Asset-backed securities, mortgage-backed securities, CLOs, as ABS, collateral-backed obligation, MBS, CLOs, project finance, and all of these are actually an application of this idea only, an idea of tranching. So thank you everyone for attending this lecture. I will see you in the next lecture where we will be discussing about uh, what securitization is. This is what securitization is, and after that, the relationship between securitization and tranching, we will discuss about it. So I will see you in next episode. Thank you for attending today's session. All the very best. My name is Deepak Best.